Welcome once again, everybody, to Middle Class Investor. This is Seth Martin, your host, and looking at a chart of the S&P 500. And we've been looking at this chart for a long time. Let's go back a little further. I want to just show you how long this bull market has been going. It's been going all this time since March of 2009. And we really haven't had, other than this pullback here, the last pullback we had that was even remotely substantial was back here in 2011. And anyway, suffice it to say, this bull market is long in the tooth, and bull markets don't last forever. And this one has lasted a long time, longer than a lot of people thought. And some people speculate that it's because of the Fed, and I don't even know why. Nobody knows why, really. But anyway, we've got let me go to the Dow, because the Dow has a more pronounced pattern that I want to talk about, called an ending diagonal pattern, and that's this pattern right here. And we've talked about the let me zoom out a little bit more, and so that when I zoom in, I can show you what I'm talking about. So we've been talking about this this thrust up here being a certain size, and then this thrust up here being smaller, and then this particular thrust up would be even smaller. And so you can see just visually, this one's smaller than this one, and this one is smaller than this one. And this is characteristic of an ending diagonal pattern. The other characteristic is the overlap, the significant overlap and the zigzagging. See how they zigzag and overlap pretty deep in the pullback areas. That's pretty characteristic of an ending diagonal. Now, the thing about an ending diagonal is typically it'll fall pretty quickly to, say, like right there, so just below this low here, and then you'll get some sort of retrace back to the line, like so, the underside of this line. And then this next move, you typically get a retrace all the way back to the start of the pattern, which is the start back here in this cluster. So obviously we don't want to be in this if that happens. So what we're going to be looking for is, we're going to be looking for a move like to here, a correction back somewhere in underneath this line here, and then we're going to be looking to move to our money market funds inside our 401k. Now, the other, what could happen, there's a lot of possibilities, but one of the possibilities is you could just have, in fact, one of my friends thinks this is going to happen, you could just have this kind of drift along, to here, and then kind of make its way up higher. And that's certainly a possibility. And so we should be able to tell if this pulls back harder, then likely that the second scenario that I mentioned is not going to be the one that we're going to be looking for. So what we're going to do is we're just going to watch the market, and we're going to let the market tell us what to do based on what it's doing. Okay, that's how you do this. But I've been talking for a while now about reward to risk. And if you recall, back here in this area, I was saying, okay, I think maybe right here I was saying, if okay, yeah, the market could go up, but maybe it could go up to here, which I think was like 3% or something, or maybe this is 3%, from here to here is 3%. But the risk to the downside was, down here somewhere, which was like 15% or something. So from a reward to risk standpoint, to me, it made a lot of sense to just go ahead and step to the sidelines back in here. Specifically, this day right here was the day or the week I was looking at, that one right there. the only reason is because to me this looked like that thrust up, last little pullback, and then the new highs right here. So that's why I was saying right here. But as it turned out, we had this protracted pullback that took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks, and then you get the big post-Trump run-up. Now, I don't think this has anything to do with Trump. You can't say that. I think people were probably positioned for Hillary to win, although materially, I don't think there was any difference. I don't think anybody really thinks anything's going to be very different with Democrats, Republicans, whoever's running the show. There's a lot of structural issues within the government, and anybody's ability to change it is it's going to be very difficult, if at all possible. But suffice it to say, you had people kind of positioned for Hillary to win, and I don't know if you remember on election night, we had this huge sell-off, and then a big rally. So they were calling it the Trump. First, they were calling it the Trump sell-off, and then they were calling it the Trump rally. So, but anyway, it is what it is. So let's take a look at the 13-week Treasury just to see what the Fed's going to do. So the Fed announcement is Wednesday, December 12th at 2 p.m. Eastern. So that'll be 1 o'clock Central. And what we've been saying is that as long as we were above this red line, which we clearly are now, that the Fed would raise rates. So we'll see if that happens. I've got this little blue box here. We could pull back to here and then rally up. We'll see what happens. But that's the way I see it right now. So let's look at volatility. Volatility is still very low. In fact, it's so low you can't even see it on your screen because it's down at the bottom. So I had to bring it up here. We've had this blue box on here forever. We've been bouncing around down there. Sometimes we got below it, like right in here. But at some point, volatility is going to blast out of here in a pretty big way. And don't know when that is. But what I do know is that we don't want to be long the market when volatility starts making its way up into this area. All right, let's see. Let's talk about I don't want to talk about Germany and all that stuff today. Let's just go to the 10-year Treasury yield. I think that's significant, what's happening in that market. So we talked about this a while back, and if you zoom in this like on a daily chart, for some reason that doesn't look right. Let's look at a 2-year. Yeah, here we go. So we kind of had this, we were talking about a lot of times when you break out of these downtrend lines. So you got this big downtrend line right here. And the interesting thing is we ran up to it and then immediately pulled back and then took another run at it, but then pulled back and almost touched it. And this is really what you want to look for right here. You want to see it break out, touch it, and then start to move out again. And that tells you that this trend is likely not going to continue, and that we've got a nice move coming up. So we were talking a little bit about that. Be honest with you, I thought it would maybe come up to maybe here and then kind of work its way back down to here like so, and then rally up like this. But sometimes the market just doesn't give you a second chance like that. So the rates broke out, they pulled back a little bit, and then just took off. I think that's significant. I've been talking about that for a while, that you don't need to be in bond funds. The thing about bond funds is they're in perpetuity. So normally the way you would do bonds, just real quickly here, I'm going to see if I can explain this real quickly, is you might have a portfolio, and in that portfolio you might have a 1-year bond, 2-year bond, 3-year bond, 7-year bond, and a 10-year bond, okay? And so what happens is every year, this last one drops off. It reaches maturity, right? So then you turn around and you buy and you put another one on top. This is called a bond ladder. And then the way it works is every year one falls off in maturity and you add one to the top, like so. And this is the way you invest in bonds. I mean, this is the better way to do it. You can invest in bond funds, but in bond funds, you don't want to be investing in bond funds if interest rates are rising, which they're clearly rising right now. It's okay to invest in bonds in a ladder if interest rates are rising, because you've always got an old bond dropping off the list and a new one coming back to the top. That's why they call it a bond ladder. So I don't want to get too much more into that, but just suffice it to say that's the difference between buying bonds and buying a bond fund. That's one of the big differences. Same thing with the 30-year Treasury. They look very similar. So yields are up and moving higher, and looks really strong. If you wanted to invest in bonds or yields, you would invest in the TBT. This is the TBT. It trades just like a stock, so you could buy, you might want to wait for a pullback. If we get a pullback, looking at this chart, we might not even get one, but eventually you'll get a pullback. And if you wanted to bet on higher interest rates and you want to invest in that, you could buy the TBT. The TBT is just an exchange traded fund that tracks the yield. So it's called the T. Just like Apple is AAPL, this is TBT. Just like that. Trades just like a stock. You buy 100 shares of TBT, it costs you $4,000. All right. Let's see. Let's look at speaking of dollars, let's look at the dollar. And some of those charts. So the dollar's been, red hot. We've got this box drawn up here. So we're looking for the dollar to move up into this area. We all know by now the market doesn't move straight up into this area, but I think clearly we're out of this this zone right here, this consolidation zone, and we could peek back into it a little bit, but I think the dollar's going here to, I don't know, 105, 106, probably in conjunction with a fall in the euro. So in fact, we probably will get some sort of pullback in the dollar, because if you're looking at the euro, the euro looks likely to, I've got this box drawn on here. Let me see if I can zoom in and show you. So I've got a box drawn in right here, and I'm looking for the euro to kind of make its way up into this box, and then we should have a pretty strong move. In fact, I think I'm going to trade that move when we get it, and or after it's retraced some, and it should we should see the euro down here in this yellow box, maybe even a little lower, maybe even down here below 1. I'm probably gonna only trade it to like 101, but you can see back here we have pretty good consolidation / congestion zone. In fact, let's put that price. Let's put that on there, maybe like right there. So we could go as far as this red line here, but I've got this box drawn just below this pivot, this big wave pivot on the euro, and we see we've had this big consolidation, and we're likely to see the euro come down into this area. But I think before it does come down into that area, you should see the euro, like I said, retest this box. So maybe make its way up into here like so, and then we bam, get a big sell off like that. So that's what I'm going to be looking for. If you want to trade the euro, then you can be looking for that too. And that's why I say that's probably will happen in conjunction with a dollar. If I can get the dollar up. I lost my internet connection. So I don't know why I lost my internet connection. Yeah, now I can't get anything back. So anyway, the other thing I can show you, because I already have it up, there's two things. One is this chart. This is a chart. This is free. You can go get it online. A guy named Deneric, his last name is Deneric. He charts all this stuff. And one of the things I wanted to show you is since 2003, this RSI, which is kind of a representation of the internals, has been falling. And that's significant because if you look right here, all this price action has been up, yet the internals have been falling. And this is pretty typical of kind of the last little bit left in a trend. You typically have the trend still moving up, but you have buyers are diminishing, by the day kind of thing. So I think that chart is kind of telling. And of course, he's got it labeled here. He's got this, and I'm not an expert on labeling all this stuff, but he's got this as a 5 of 5, 5 of 5 of 5 of 5. That means this trend, if we're at the end of it, he's saying this is 1, 2, 3, 4 degrees of trend. So when you correct 4 degrees of trend, it makes for a pretty big correction. So just beware of that. The other thing I wanted to mention is Italy. We've talked about this before, but Italy's banking system is a lot worse than ours was in 2008. They've got, I think about 6 or 7% of our home loans were in default. Italy's got almost 20% in default. So their banks, in fact, right up until now, they've been just kind of cobbling together a solution, which really is not a solution. And so the dynamics are over there is you've got these countries that are in the Eurozone, they all use this common currency, and the way currencies are issued is the way currency comes into creation is through debt. So for say the Eurozone to bail out Italy, that means that would harm Germany, it would harm France, it would harm these other countries. So nobody wants to bail anybody out, which can't blame them. And so they're looking at a bail-in, okay, a bail-in. Now, bail-in is where they take the depositors. So a depositor is just like any citizen, just like I'm a depositor, bank depositor. Presumably, you guys are bank depositors. So what they do is and this is something most people don't know, when you take your money to the bank and you deposit into their account, you transfer title to that money to the bank. So the bank can then do really whatever they want with the money. It's in a sense not yours. Now you still have claim to it, but you transfer title to it. And so what a bail-in is they take advantage of that. So what they do is they take your money. Let's say you got $5,000 in your account. They take $4,000 of it and they say, "Congratulations, Mr. Depositor. You now own $4,000 worth of stock in our bank. And this other $1,000 you can get, and we'll give it to you at $100 a day or something like that. But the $4,000 is no longer will be accessible to you through a checking account or a savings account. It's stock in the bank, and oh, by the way, you can't sell the stock. So it's a form of theft but it's what in fact, that's the same scenario that our banks, our Congress has put into practice with this Dodd-Frank Act. They basically are saying, hey, these banks are too big to, they're not too big to fail. They're going to have to stand on their own. And this is kind of the scenario. This is the solution they're coming up with. This guy Renzi, he doesn't want to do that. He's trying to make some structural changes to their constitution. It's kind of a power grab, but the bottom line is, if he doesn't get his way, so if the population says, no, Renzi, you can't do any of this stuff, then he's going to resign. And probably what will happen is the banks will go through some sort of bail-in. And this, assuming it works, I mean, it probably won't, but if it does or doesn't really matter what happens. You could see a lot of action in the market next week because of this Italian referendum. It'll be kind of like the Brexit vote. They're not voting to leave, but it's one of these populist movements that's creating a lot of turmoil in the status quo kind of markets and stuff. So just be aware of that. That's Sunday evening on the 4th of December. So you could wake up Monday morning to quite a bit of volatility and craziness in the market. And just know that that's bleeding over from Europe and specifically Italy. Now, Germany has its own problems. Germany's Deutsche Bank is in bad shape, and it's a huge bank. It's a ginormous bank with all kinds of collateral and stuff all over the world, and loans all over the world, and I mean it's an enormously influential bank, and it's got its own problems. So there's going to be some issues in Europe, and likely those issues are going to spill over into our economy, which is probably going to coincide with this 5 of 5 of 5, trend reversal, which is going to take us down, way down here somewhere, probably to the 2010 lows and maybe lower. So anyway, that's just so you just need to be prepared. This is the thing. You don't want to wait until the market. We've talked about this before. You don't want to wait until the market's crashing before you decide. Before you start thinking about, okay, what am I going to do? What if the market goes to here? What am I going to do? What if the market goes to here? What am I going to do? What if it goes to here? What am I going to do? You need to have these decisions already made so that you can just go take action. You don't want to be sitting there going, calling everybody, hey, what should we do? What should we do? You want to kind of decide what to do and be taking action when something happens. Because once it gets going, panic sets in, and that you can really, a lot of value can be wiped out in a pretty short period of time before you've even made a decision. So that's kind of why I started this YouTube channel and doing this. Is I really wanted to make sure people didn't lose half their money again. I mean, I did in 2000, but I didn't in 2008. I managed to keep my money in 2008, 2009. So a lot of people lost money and just recovered, last year or maybe the year before. And so anyway, that was part of why I wanted to start this. And so hopefully when it comes time, it will help you and your friends and family and some people avoid that kind of catastrophe. So anyway, without further ado, that's really it for this week. Like I said, I lost my internet connection, so we can't go back to the charts. There wasn't really more to show there. Gold is near a bounce. Gold, you should see a pretty good bounce in gold pretty soon. So if you're looking to actually buy physical gold, we might be in a good spot to do that, or silver for that matter. Except the dollar's we're looking at a dollar that's going to run up into the 105 area. You'll probably see the euro below parity, $1 to the US dollar, or €1 to the US dollar. And so it looks like to me these markets are lining up for something to start for things to start moving here within the next week or maybe two. So keep your eyes open. Come back to the Middle Class Investor. We'll talk about it here. And until then, you guys take care, and we'll see you next time. Goodbye.